Everyone's watching the AI bubble. Every headline, every finance bro on YouTube, every analyst on TV, they're all staring at the same thing, waiting for it to pop. But there's a bigger problem. One most people aren't even looking at. For the last 30 years, one country has quietly been the shock absorber for the entire global financial system. Cheap money, endless liquidity, a currency that never moved. Wall Street built entire strategies on the assumption that this would never change. It's changing right now. And when it finishes changing, it could hit stocks, bonds, real estate, and crypto all at the same time. This is the story of Japan, and why what happens next in Tokyo might matter more to your portfolio than anything happening in Silicon Valley. To understand the risk, you have to go back to 1989. Japan in the late 1980s wasn't just a strong economy, it was the story. Tokyo real estate was so overheated that the land under the Imperial Palace was, on paper, worth more than the entire state of California. Japanese companies were buying up trophy assets in the U.S. Rockefeller Center, Columbia Pictures, golf courses, hotels, business schools taught Japanese management as the model the West needed to copy. Then the bubble popped. The Nikkei stock index lost nearly 40% in a single year. Real estate values collapsed. Banks were sitting on mountains of bad loans they didn't want to admit were bad. And instead of forcing the pain through quickly, Japan tried to manage the decline, slowly propping up zombie banks and zombie companies rather than letting them fail. The result was decades of stagnation. Growth near zero. Prices flat, or falling actual deflation, which sounds harmless until you realize it means consumers keep delaying purchases because things will be cheaper next year, which kills demand, which kills growth, in a loop that feeds itself. To fight this, the Bank of Japan did something no major central bank had ever done at that scale. It pushed interest rates to zero and then kept them there. Not for a year or two, during a crisis for most of 3 decades. At one point, rates even went negative, meaning banks were effectively paying a fee just to park money at the central bank. It didn't fully fix Japan's growth problem, but it created a side effect that reshaped global finance. Japan became the cheapest place on earth to borrow money. Here's where it gets interesting for the rest of the world. If you can borrow yen for close to nothing, and then take that borrowed money and invest it somewhere that pays a real return, U.S. Treasury bonds, U.S. stocks, emerging market debt, even Bitcoin, you pocket the difference. That's the entire idea behind what's called the carry trade. Say a hedge fund borrows yen at roughly 0% interest. It converts those yen into dollars and buys U.S. bonds yielding several percent. As long as the exchange rate between the yen and the dollar doesn't move much, that fund is earning a spread for doing almost nothing, just holding the position. Now scale that up. Hedge funds did it. Pension funds did it. Insurance companies did it. Even individual Japanese retail investors did it. In a strategy nicknamed after Mrs. Watanabe, the archetypal Japanese homemaker managing the family's savings, borrowing cheap yen to chase higher yields overseas. Multiply that across 3 decades and you get an enormous tangled web of leveraged positions, all funded in yen, all sitting in assets around the entire world. Nobody knows the exact size. Estimates have run into the hundreds of billions of dollars, and by some counts much higher once you include all the indirect exposure. This is the part people miss. The carry trade doesn't just move money into other assets. It suppresses volatility. It's a steady source of buying pressure that keeps flowing as long as 2 conditions hold: Japanese rates stay near zero, and the yen stays weak and stable. Wall Street, more or less, priced in the assumption that Japan would never move. For 30 years, that assumption was safe. Then Japan started raising rates. In 2024, the Bank of Japan made its first real move away from near zero rates in years. Small steps at first, But by 2025 and into 2026, those steps became a clear trend, and Japan's central bank has now pushed its policy rate to the highest level in roughly 3 decades. That single fact changes the entire equation. Remember, the whole trade depended on one country's money staying free. Once Japan's own interest rates start climbing, the math on borrowing yen to invest elsewhere gets worse and worse. The gap between what you pay to borrow and what you earn abroad, the carry shrinks. At some point, it isn't worth the risk anymore. When that happens, positions start unwinding. Investors sell their overseas assets, convert the proceeds back into yen, and use them to pay down the yen they originally borrowed. That's called repatriation, the money going home. This isn't hypothetical. It's already happened in miniature. In the summer of 2024, a single Bank of Japan rate hike triggered a sharp, sudden unwind. The yen spiked. Japan's own stock market had one of its worst days in decades, and the shockwave spread straight into U.S. markets, a rough day for stocks and a sharp drop in crypto within hours. That was one rate hike. A preview. The danger isn't a single move. It's the cumulative effect of a multi-year trend. Every additional hike from the Bank of Japan tightens the trade a little more. Every hike makes it a little more likely that big leveraged players decide it's time to close positions before someone else does. And because so much of this is built on leverage, unwinds don't tend to happen calmly, they tend to happen all at once. Because everyone is trying to get out through the same door. That's what makes repatriation dangerous. It isn't really a Japan story. It's a global liquidity story. And the U.S., which has absorbed enormous amounts of that yen-funded capital into its stock and bond markets, sits directly in the path. So why should someone sitting in the U.S., watching their 401k, actually care what Japan's central bank does? A few reasons. First, demand for U.S. debt. Japan has been one of the largest foreign holders of U.S. Treasury bonds for years, partly funded by this same cheap money dynamic. If Japanese investors are incentivized to bring capital home instead of continuing to buy U.S. debt, that removes a steady buyer at exactly the moment the U.S. government is issuing more debt than ever. Fewer buyers or pickier buyers tends to mean the U.S. has to pay a higher interest rate to attract them, and that ripples into mortgage rates, corporate borrowing costs, and eventually into how expensive it is for the average American to borrow money at all. Second, volatility, not just direction. A slow, orderly unwind is manageable. A panicked one is not. Because so much of the carry trade is leveraged, forced selling can hit multiple asset classes at once. Stocks, bonds, and crypto have all shown this correlation in past unwind episodes. That's the scenario markets fear, not a gentle rebalancing, but a rush for the exits. Third, this isn't limited to hedge funds. These flows are woven into pension funds, insurance portfolios, and index funds that ordinary investors hold without realizing it. You don't need to have heard the words carry trade to be exposed to what happens when it unwinds. The optimistic case is that the Bank of Japan keeps this gradual, small, well-telegraphed hikes that give markets time to adjust, which is largely what's happened so far. Central banks generally prefer boring and predictable over dramatic. But gradual assumes nothing else goes wrong at the same time, no surprise inflation print, no geopolitical shock, no sudden shift in risk appetite. In a market this leveraged, it doesn't take much to turn an orderly process into a disorderly one. For 30 years, Japan was the quiet exception, the one major economy the rest of the world could count on to keep money cheap. That exception is ending. It doesn't mean a crash is coming tomorrow. It doesn't mean you should panic sell anything. But it does mean one of the most important, least watched threads in the global economy is unwinding in real time, and it's worth understanding before it shows up in a headline as breaking news. If you found this useful, subscribe for more breakdowns like this one, and let me know in the comments what you want covered next.